You know, something really shifted in the market last week. And it wasn't just another down day. It felt different. It felt like a warning shot. So, in the next few minutes, we're going to break down exactly what those signals were, and more importantly, what they might be telling us about what's coming next.
Yeah, this wasn't some small dip or a quiet Tuesday afternoon. There was a fundamental change in the market's whole vibe, its behavior, a sudden jolt that really got everyone's attention. So that's the big question for this explainer, right? What are these signals? What do they actually mean? And what do they suggest might be just around the corner? We'll start by digging into the key events from last week. To really get what happened, we need to look at three key events that fired off almost at the same time. These were, without a doubt, the market's warning shots. First up, the VIX. You know it, the market's fear gauge. It just exploded, surging 13% in a single day to hit that 30 level. And just to put that in perspective, anything over 20 usually suggests people are getting nervous. Hitting 30, that is a whole different level of investor anxiety. At the very same time, the S&P 500 broke below a supercritical technical level, its 200-day moving average. For so many of the big institutional investors, that is the line in the sand. Crossing it is a major red flag. And then, to complete the trifecta, oil prices were pushing to new highs. This just adds another layer of complexity to everything because rising energy costs often point to broader inflation, which is, as we know, a huge headwind for the market. Okay, so we've seen the warning shots. Now, let's connect the dots and actually decode what these signals are trying to tell us about the market's real health right now. That 200-day simple moving average, the SMA, it's not just some random line on a chart. It is a major long-term trend indicator for the big institutions. For a lot of them, being below this line can trigger automatic selling or a complete shift in strategy. It basically means the prevailing uptrend we've been enjoying is now officially in question. A VIX at 30 is historically a really big deal. It signals a state of pretty high fear where investors are actively running out and buying insurance for their portfolios. They're not just worried, they're taking action because they expect much bigger, wilder price swings ahead. But here's the thing. It wasn't just that the VIX hit 30, it was how fast it got there. A sudden, sharp spike like we saw tells you that investors and institutions are scrambling to adjust their positions and they're doing it fast. This isn't a slow-moving concern, it's a rapid, collective, uh-oh moment. And this building anxiety wasn't just visible in the broad indexes and charts. The weakness went right to the top. The biggest, most influential companies, the ones that have been leading this market higher, well, they also started to stumble. We are talking about the titans of the market here, Meta, Amazon, Microsoft. These companies are so massive, they can practically steer the entire market by themselves. So when they all start showing weakness at the same time, it's a powerful signal that the problem is pretty widespread. And here's the key insight. You can kind of think of these stocks as the market's generals. And if the generals are retreating, it's incredibly difficult for the rest of the army of stocks to keep advancing. Their weakness is a really strong sign that overall market confidence is cracking. This whole sudden downturn might feel like it came out of nowhere, but really it was just an amplification of some quieter warning signs that had already been building under the surface for weeks. For weeks, we were seeing clues, things like weakening breadth, which just means fewer and fewer stocks were actually participating in the rally. We saw leadership fatigue among those big names, and volatility was already starting to creep higher. Last week, all those whispers basically became a shout. So, where does that leave us? Well, all signs are pointing to the market now being in a transition phase. Now, this isn't necessarily a full-blown bear market, but that easy, clear uptrend, that's gone. We are now in a period of change and, frankly, heightened uncertainty. A transition phase has three distinct hallmarks, all of which are flashing right now. The trend is under pressure, the price structure is below that key 200-day level, and volatility is elevated. Historically, that combination is a recipe for unpredictable, choppy, and just plain difficult market conditions. So, with this new environment, what should we be watching next week to get some clarity? Let's go through three key factors to focus on. I'll be watching three things like a hawk. First, can the S&P 500 get back above its 200-day moving average? A move back above would be a huge sign of strength. Second, what does the VIX do? Does it calm down, or does it stay elevated up there above 30? And third, do the market generals, Meta, Amazon, Microsoft, find their footing? The answers will really tell us if this is just a pullback or maybe the start of something more serious.
So the crucial point and the main takeaway from all of this is to approach the market with a bit more caution. This is not a signal to panic, but it is a clear signal to be more observant, to manage your risk, and to understand that the market environment has definitely changed.
And as always, this is simply my framework for trying to make sense of all the noise. The goal is to observe the key signals and build a clear, rational perspective, rather than just reacting to scary headlines.
So I'll leave you with this final thought. Knowing that the easy trend is over and volatility is back in the picture, how will you adjust your own approach to navigate this more challenging market? Thanks for tuning in.